Hi, welcome back to Cheryl Trades Leaps. You know what's interesting? Most investors don't actually lose money because they're wrong. They lose money because they're late. They buy when everything feels safe, when the headlines are positive, when the chart looks perfect, and ironically, that's usually when the risk is the highest. That's the trap at market tops. And today, I want to show you how that actually works, because once you see it, you can't unsee it. 1. The illusion of strength. At a market top, everything looks strong. Price is going up. Breakouts are working. Confidence is high. It feels like confirmation, like, okay, now it's safe to get in. But here's the part most people don't realize. Price is the last thing to break. By the time price looks the strongest, underneath the surface, the structure is already changing. 2. What you don't see. This is where most people get trapped. Because while price is still pushing higher, something very different is happening underneath. Let me give you a simple picture. Let's say the market index, like the S&P 500 or the NASDAQ 100, is going up. Looks strong, right? But under the surface, only a few big names, like NVIDIA or Microsoft, are actually pushing it higher. Meanwhile, a lot of other stocks, they're flat. They're already dropping. They're not breaking out at all. So the index looks strong, but most stocks are not participating. That's called narrowing breadth. And it's a warning sign. Because the market looks strong, but it's actually getting weaker. 3. What smart money is doing. Now, here's where it gets even more important. At this stage, smart money institutions, they're not chasing anymore. They're distributing, which means they're selling into strength. They're letting retail push prices higher, and they're quietly exiting without crashing the market. And here's why it's dangerous. It doesn't look like selling. It just looks like normal price action. No panic, no big red candles, just quiet exits. 4. The retail trap. So what does retail see? They see breakouts, they see strong charts, they see positive sentiment, and naturally, they buy, because it feels right. But what they're actually buying into is late-stage momentum, weakening structure, and institutional exits. And when the liquidity disappears, that's when things change. Price doesn't slowly drift down, it drops. Fast. 5. Why this matters for leaps. Now let's connect this to your strategy. If you're trading leaps, timing matters a lot more than people think. Because if you enter at the wrong time, you're overpaying for momentum, you're overpaying for implied volatility, you're buying at peak optimism, and even if your long-term thesis is right, your entry can still destroy your returns. 6. How to avoid the trap. So what do you do instead? You don't need to predict the top. You just need to stop chasing it. Focus on pullbacks, not breakouts. Early trends, not late trends. Confirmation, before you size up. This is the mindset shift. Be early with small size and only go bigger when structure confirms. That's how you stay aligned with smart money instead of getting trapped by it. If you want to trade leaps the right way, you don't chase strength. You wait for opportunity. And if you want more breakdowns like this, real strategy, real structure, subscribe to Cheryl Trades Leaps. Because this is how you start trading with discipline, not emotion. Thank you for watching and see you in the next video.